Welcome to the Skeptic's Guide to Investing with Steve Davenport and Clem Miller. Every 2 weeks, Steve and Clem bring you brief investment insights you may not find anywhere else. We hope you enjoy today's episode. Here are Steve and Clem.
Hello, this is Steve Davenport from Skeptic's Guide to Investing. I'm here today with Clem Miller, and we're going to try to talk about what is the major media event for the last 6 to 9 months, which is Fed watching and the Fed and their decision about when they will possibly lower rates. There seems like a lot of other things to think about with Ukraine, Gaza, the overall intensity of inflation in various areas, real estate, interest rates. But we in the media are looking at this and saying, should we really be focused on the Fed? Is the focus on the Fed misguided? What is their real purpose, and how do we use that as a form of alpha for our strategies? Can you add alpha from this idea of looking at the Fed? If it were true, then everybody's Fed watcher would be the highest paid person at the hedge funds, right? And I'm not sure that's the case. I think that when we look at this, and I want to ask Clem because he's much more of a fundamentalist in terms of how the companies react, I look at this and I say, the Fed is trying to use one measure, interest rates, as a way to influence the economy. And when we think about the U.S. economy, we think about Texas and the oil regions and Oklahoma and other areas. We think of technology in Silicon Valley and up in the great Northwest near Seattle. And then we look at auto production in middle America, and we look at the financial sector in New York. Each one of these areas or Fed districts is going to have a very different view of how interest rates affect us, right? If we have an area that's growth is coming mostly from housing, aka Florida, North Carolina, South Carolina, those areas should have a much bigger influence in terms of how interest rates affect them. Other areas, like the technology areas in California, they're not using debt. Therefore, if they're not using debt, does the rate matter? Does the rate matter for Microsoft? Does the rate matter for Oracle? Is it about AI and nothing about interest rates? If it is, then you could take whole sectors of the economy and just move them away from this discussion. And if you think about where's the growth in the economy, why would we focus on interest rates when we can focus on growth rates of 20 or 30% because of new insights into how AI will evolve over the next 5-10 years? It's a much nicer discussion because it has a much better result. An extra 50 basis points may mean something bad for a lot of the commercial real estate holdings of mid-sized banks, but it doesn't mean anything to the technology sector. Clem, when you look at the Fed, and I'll just say A or B, relevant, irrelevant.
I would say mostly irrelevant because, and I would use a somewhat different word. I would use the word actionable from an investment standpoint. Is all this Fed watching really actionable? And I would say that it is not actionable. And I would give a few reasons for saying that. You've touched on a few of them, which is that the economy is really too broad for the Fed to act. I would say that, if you look at what some of the media, the business media, talk about, you would, with regard to the Fed, you would think that the U.S. is a centrally planned economy like the Soviet Union used to be, that the Fed is pulling the strings as if the economy was some kind of marionette. And it's really not. The economy has a life of its own. And if anything, the Fed is is really riding this bucking bronco that it really can't control. And so I would say that, really it's hard to be able to look at the Fed and say that, they're doing that, they are the ones that are in control of the economy, because they certainly are not in charge of the economy. Now, I would also say that there's a certain amount of expectations theory that's involved in looking at the Fed. So it's not a question really of trying to determine what the Fed is going to do, which is really the content of a lot of media and personalities, economists who talk about this. It's really the more important thing is discussion of whether the expectations regarding the Fed and Fed actions are actionable. And there you've got so many folks, from all the investment firms that have economists, chief economists and whatnot, who are looking at the Fed. You got so many folks looking at this that it's there's a consensus opinion that arises. And, you could only really make, if you assume that the Fed was in control of the economy, you'd only be able to make money if you had a non-consensus opinion that was actually correct. And, the tendency of many economists is to not, move away or not challenge the overall consensus. They get paid to make decisions, and they're never going to get their pay docked if they make a decision that everybody else is making, or offering an opinion
They
that's
all get it wrong.
different. What?
Or if they all get it wrong.
Or if they all get it wrong. If they all get it wrong, they're still not going to get docked because everybody else got it wrong too. So yeah, I think given that this is about, that the only way to make money is to have a non-consensus opinion that's correct, I think that the opinions and the analysis of the Fed is really not all that actionable compared to looking at other things that are affecting the economy. And by that, it's not just the U.S. economy. We're talking, the global economy is important too, since some 40% of S&P 500 revenues come from abroad. U.S. economy the global economy is important as well. So whether the Fed is relevant or not I think it's much less relevant than many people actually think it is. People spend
I started to think about this, and when I looked at, I'm a big believer in the research that talks about the wisdom of crowds, right? And when you think about the wisdom of crowds, these people gravitate towards something. And we're going to talk about meme stocks later in another podcast, but when you see people moving in a certain way, and you see a lot of attention given to this Fed, you would suspect I wouldn't give something this much attention unless there was this much benefit, right?
Yeah.
I mean, we're economic animals who are driven to, we've got 8 hours in a day that the market's open, and we look at it and say, okay, how do I use those 8 hours to help my clients generate better risk-adjusted returns and move on in terms of capturing growth and extracting value? But I just am amazed, Clem. Why is there such hope? Like, if you and I are right, and that it is mostly irrelevant, which I believe is the right decision, how does it become such a fervor and such an intense speculation about this event or potential event when we say, gee, if it were inefficient to do this, people wouldn't waste their time? But yet we say over and over and over again that they do waste their time.
Yeah.
So I guess I'm having trouble with the economic animals and CNBC and how they are looking out for the average investor out there watching TV. And maybe the average investor isn't watching TV. Maybe the average investor is sitting there and saying, I never watch CNBC because it hypes up too many things and it gets too involved. Is it possible that as an industry, we've given people a lot more credibility than they should have, or given them a lot more power to talk about a topic that maybe it isn't? Maybe it is relevant. We're just not educated enough to appreciate the subtleties.
We'll be right back.
We hope you're enjoying our episodes. If you are, then we'd greatly appreciate your liking, following, and sharing. Help us help others. Now let's get back to the discussion.
Yeah, I mean, I think that, like I said, like you've said, I think that, that investors put way too much emphasis on what the Fed may or may not do. There's, a big focus on, everybody knows that when the Fed acts, they act on the basis of what's going on with inflation, and also with employment statistics. And those are not really all that predictable. And so you could have, 1 week, you could have inflation go down. The next month, 1 month, you could have inflation go down. The next month, you could have inflation go up. 1 week, you could have unemployment go down. The next week, you could have unemployment go up. And it's sort of, basically jerking around investors who,
Noise.
Yeah, it's noise. Really, it's noise. And a lot of investors are looking at that, and trying to make decisions based on this noise. And you know what, Steve, they are playing into the hands of speculators. It's the speculators who are making money off those who just don't know that they should focus on on fundamentals of individual stocks, and especially those. It's much better to sort of hold on to positions, buy and hold, than it is to buy and sell all the time based on to do a lot of trading. Like I'm talking about moving to cash, moving out of cash, moving into cash, moving out of cash, based on whatever's happening with inflation and employment in a particular week or month. It's sort of crazy how much people look at this one institution and make decisions based on what this one institution is doing. I mean, it's like it's like the movie, right? Wizard of Oz. The Fed is not Oz. Or let's put it this way: the Fed is Oz. Has no.
I was a little taller than Oz, but he's not completely different than Oz.
In fact, I kind of believe, if I remember correctly, that the Wizard of Oz was kind of an analogy for the Fed. If you look back, there are a lot of analogies in that movie, and I think the Wizard of Oz was an analogy for the Fed, and I think there was some wisdom to that back in the 30s. And now we're about 90 years away from that, and I think it's still appropriate.
I agree. I think the other aspect of this, and I know that you'll have a little trouble with this word, but it could be, to me, that there's politics involved here, Clem. And I look at this and I say, if this is an institution who's trying to make the right decision, and yet they tell people it's highly favorable for us to not do any increases or decreases around the election, because then we'll be viewed as political and they'll be politically motivated. And I sit there and I go, isn't the whole world political?
Yeah.
Are most decisions having an influence of somewhat from politics?
Absolutely. And to not
have
make
this idealist view of the Fed, like they are this they take the information and they bring it to the mountaintop, and everybody comes to the table, and at the table, all ideas are shared, and there is general looking for consensus and looking for a better ideal of how the economy should operate. It feels to me a little bit like, how do we come and tell ourselves these stories that make us believe that, yes, these people are so wise and so good that they will not make decisions, even if the data is saying, just so they avoid the outcome of looking political.
Yeah.
Does that make sense? I mean, if the rates come down, they should come down in February. They should come down in September. It shouldn't be, oh, wait a minute, we're this many days away from the election, and therefore we can't lower rates, because that would just look too political, right?
Well, yeah, I mean, and a decision not to do that is itself political. So no matter which way they go, it's a political decision. Either way.
Yeah, I just think that trying to, why don't we simplify according to our two variables? We are making this decision based on how we see the price control. We are making this decision based on what we see from employment. And we have this third rail or third variable, which is, how is the market doing? Because if the Fed really looks at itself and says, how many decisions has it made in the last 10 years? Tell me, how many of them have been based on a reaction to the market being too high, too low, or suddenly not working the way it was supposed to work? I would say that it's probably in that 70, 80% of the decisions are based on the market of securities, which are only owned by half of the economy. So if the population doesn't all own stocks, does the Fed really need to be focused on how stocks are reacting? Or is it really the underlying economy? Are stocks the underlying economy, Clem?
Oh, of course not. But from an investor standpoint, you can't invest in the economy. You can't invest in GDP. You just can't, right? There's no instruments for doing that. You can invest in stocks, and stocks don't represent shares of the economy. They're more than that. They represent earnings growth, which is based on U.S. and basically global economic growth, based on shares, which can be bought, which can be repurchased, dividend yield, multiple expansion, which is partly based on rates, but also partly based on things like geopolitical risk in terms of spreads. There's a lot that goes into share prices that go way beyond just Fed control of interest rates. In fact, the Fed can't even control long-term yields, long-term treasury yields. Long-term treasury yields whip around regardless of what happens with the Fed on the short run. They don't control even the whole yield curve.
Right.
I mean, unlike in Japan, which until recently was trying to control the whole yield curve, the U.S. doesn't do that. The Fed doesn't do that. And if anything, the longer end of the yield curve, 10-year treasury yields, that's way more important for stocks than what happens on the short end with the Fed funds rate.
Well, I understand companies borrowing and companies need access to capital, but again, isn't that industry specific? It's not really all companies. A lot of companies, small companies, are funded by internal cash flow. So they don't need to know what the rates are. They just need to know how their business is doing. And if real estate seems to be the one that I think has just been crazy recently, is these higher rates were going to cause a downturn in real estate, and it hasn't happened.
Yeah, I mean,
this little supply.
I mean, real estate is a great example. And in fact, the whole economy, or the whole stock market, I should say, has been doing quite well, right? despite the fact that rates continue to remain high. So, coming back to our, is the Fed providing us actionable information? If you just based your stock market decisions on how high the Fed funds rate is, you would have lost out on a whole bunch of stock market appreciation over the last couple of years. I mean, you'd be looking at if you based it all on the Fed, you'd be looking back and saying, gosh, I missed out on all of this stock market appreciation. You'd feel terrible. And I'm sure some of you may have done that and are looking back and saying, darn, I shouldn't have done that.
Well, I think that, first of all, I think it simplifies the story. If you're in the media at CNBC and you say people want a simple story, they want to understand higher rates mean bad for the economy, bad for stocks. Lower rates, good for stocks, good for the economy, good for spending. And I would love for the world to operate in simple if-then, but I've come to the belief that we all have multiple variables. It's a multivariate approach. There's 4 or 5 variables: earnings growth, overall, corporate structure, capital allocation decisions. There's many things that we need to put into the equation, and the Fed's influence on interest rates is one of those variables. And I guess, do you have, if I said the economy and the stock market is going to be based on these 4 variables, and how I believe that I'm bullish or not is going to be, if all of these things are clicking, these are going to be the things that help us to achieve better results. What would be your top 4?
Well, I take a look at this from a stock perspective, and things you mentioned, capital allocation, that's something that is a management decision, company by company by company, which you can see based on, where the free cash flow is being allocated. So a lot of that is based on individual, company decisions. But if you aggregate it, if you look at this on an aggregated basis, which I think is the, sort of where you were going, Steve, with the question, I think taking a look at dividend policy, dividend growth, dividend outlays as a percentage of free cash flow or earnings, I think that's a key element. Dividends plus stock buybacks. The higher the stock buybacks, I think the better. Overall revenue growth in the economy, or overall revenue growth of S&P 500 stocks, I think is relevant. And of course, that's a function of the US and global economy. Profit margins, right? Because profit margins are what convert revenue growth into profit growth. And, as I pointed out, share buybacks convert profits into earnings growth. And then, of course, multiple expansion, right? So that's relevant as well. So all of those things are important. They're important at the aggregated level, and even much more important at the individual stock level.
Right. My point was going to be, if we came up with 4 or 5 variables, I think it would be harder. I think it would probably be more like 6. And then you'd say, how do I make one of these variables worth a lot more than the others? And then you'd say, I probably would just equal weight them, just because I don't have a definitive way to isolate the variables. And then I'd kind of go, okay, if there's 6 and there's 16% each in terms of impact on the underlying, the Fed is one of 6.
Yeah.
One of 6 variables. It's not
right. I wouldn't even put them in the 6.
I think interest rates and its impact on consumer spending and all the things that flow from the Fed. Corporate capital structure decisions are made based on, companies did a lot of borrowing before the Fed raised rates, right?
Yeah.
So they obviously thought something was important.
not the Fed funds rate. That's much less important than the 10-year Treasury.
I agree. It's a nuanced view of how the Fed rate impacts the whole economy. It's not a direct from the overnight rate. But I guess what I'm saying is if the
you're saying
direction of rates is higher or direction of rates is lower,
we're
going to have different.
You're saying, and I totally agree, that there are multiple levers to what's going on with stocks, and maybe the Fed is one of those levers, but there are many more levers that are involved that the Fed has absolutely no control over. And the overall investment community, especially retail investors, have much less knowledge about all the levers that go into this because of the media's overwhelming focus on the Fed. Is that about right, Steve?
Yeah, I was looking for a summary, and you gave it to me before I even asked. So I believe that we as a society spend too much time on the wrong issues. It's about your time in the market, not timing the market, right? Yeah. That's, if you look at all the research, lower your fees, be more patient, and stay in the market through bad times and good, and work on your savings so that you have more alternatives available to you in your financial future. All of those things have nothing to do with the Fed. So when I look at an individual, should an individual spend time thinking about whether Steve Leisman is being overly bearish or bullish? Steve Leisman is just another person who has an opinion. I look at it and say, save, invest, do it for a long period of time, not trade, but invest, and do it in a way that's effective, meaning hopefully your fees are not too high. And I think that most of the people would walk away with, I got something that's going to be very helpful to me. Now I know what to avoid. Because I think if we spend our time only focusing on what we do, we also have to spend our time focusing on what we don't do, right? Let's not focus on the Fed. And if we make that decision, all of a sudden I've given a person, an hour a month that they can now go and, do something else in their life that's going to give them more joy and more results, right?
Yeah.
So thanks for listening today. We hope you enjoyed the Skeptic's Guide, and we hope all of you will continue to listen and continue to enjoy what we do. If you have any ideas, please call us or email or text. Thank you.
The views shared on this podcast represent the personal investment views of the hosts. They are for educational purposes and not meant to be taken as investment advice. Listeners should consult their own investment, legal, and tax advisors. Past performance of any investments is not a guarantee for future return.